As of right now, the U.S. markets are closed for the weekend, but the numbers from the last session tell a complicated, almost deceptive story that every single person holding or watching this stock needs to hear immediately. Tesla stock finished the last trading session on Friday, November 21st at exactly $391.09, down $4.14 or 1.05% on the day. While the 1% drop might look like standard noise on a chart, the way it happened, opening significantly higher at $402.32, only to be aggressively sold down throughout the day, is a flashing signal that the easy money phase of the recent post-election rally might be hitting a brick wall. In the after-hours market, we are seeing a slight tick upward to around $393.83, but do not let that minor green flush fool you. The real story is in the rejection of that $400 level during the regular session. Here is where the tension lies, and it is exactly why so many retail investors get caught on the wrong side of the trade. The expectation right now, the narrative flooding your social feeds and the headlines on every financial news station is that Tesla is the chosen one of the new political administration. The belief is that regulatory hurdles are going to vanish, the government is going to hand-wrap autonomous driving legislation, and the stock is destined to fly back to its all-time highs without resistance. That is the expectation. The reality, however, is that the market is a mechanism for humbling the crowd, and what we witnessed on Friday was a classic bull trap, where enthusiasm was used as liquidity for institutional exits. The reality is that while the long-term story has arguably improved, the short-term valuation has stretched so far beyond the fundamentals that the rubber band is threatening to snap back. If you're sitting there thinking this dip is just another buy opportunity without checking the technical damage done at $402, you might be walking into a buzzsaw. Let's break down exactly what happened during the Friday session, because the intraday movement was a masterclass in psychological warfare. The stock opened strong, gapping up above $402, enticing the fear of missing out crowd, the folks placing market orders on their Robinhood app or logging into SoFi Invest first thing in the morning to catch the momentum. For the first few minutes, it looked like the breakout was real, but almost immediately, heavy selling pressure stepped in. This wasn't just profit-taking, this was distribution. While retail traders were buying calls thinking the momentum from the election was still fresh, larger players, likely executing through prime brokerages like Interactive Brokers or Fidelity Investments, were unloading inventory. The stock didn't just drift lower, it was pushed. It hit an intraday low of $383.76, completely erasing the morning optimism. When a stock opens at the highs and closes near the lows, it creates a candlestick on the chart that screams rejection. It tells us that every single person who bought Tesla stock in the first hour of trading is now underwater, holding a bag and wondering if they should sell. That psychological pressure is what fuels further downside. To understand why this is happening, you have to look at the broader context of the Trump trade or the political rally we have seen over the last few weeks. The market priced in a perfect scenario for Elon Musk's empire effectively overnight. The assumption was that his proximity to the incoming administration would instantly translate to cash flow. But the market is now waking up to the cold, hard math. Even with favorable legislation, things like a national robo-taxi network or full autonomous driving approval are logistical mountains that take years, not weeks, to climb. We just got news that Tesla is eyeing February 2026 for full self-driving approval in Europe. That's great news, but it's also more than a year away. The market, in its infinite impatience, ran the stock up as if that approval was happening next Tuesday. We are seeing a recalibration. The investors who use Schwab Intelligent Portfolios or manage their own Fidelity IRAs are starting to look at the PE ratio, which is sitting at around staggering 261x, and asking if the growth currently justifies paying that premium right now. This brings us to a critical comparison. Look at what happened with Nvidia stock in the same session. Nvidia dropped nearly 3%, dragging the entire tech sector down. When the leader of the AI bull market sneezes, high beta stocks like Tesla catch a cold. Investors often group these names together, Tesla stock, Apple stock, Nvidia, as the must-own tech leaders. When risk-off sentiment hits one, it bleeds into the others. We saw a rotation out of the high-flying tech names on Friday, likely as portfolio managers rebalanced ahead of the month end. This is not necessarily a disaster, but it is a changing of the tide. The momentum traders who use Robinhood stock trading for quick flips are finding that the easy setups are gone. Volatility has returned, and volatility is the enemy of the highly leveraged long trader. Let's talk about who's actually moving this stock right now. You have two distinct camps. On one side, you have the retail army, the folks engaged in self-investing, who believe in the mission and are willing to hold through anything. They're dollar-cost averaging, buying fractional shares on Robinhood cash management accounts or adding to their SoFi active investing portfolios. They see 391 and think discount. On the other side, you have the institutional smart money. These are the funds using complex algorithms on platforms like interactive broker stations to hedge their exposure. The options market activity for Friday showed a significant amount of put buying. This means the big players are paying insurance premiums to protect themselves against a drop below 380 or even 360. When you see the smart money buying insurance while the dumb money is buying call options, you need to pay attention. It suggests that the floor might be lower than we think. I want to challenge the way you think about investing versus trading here. Many people turn to online investment sites looking for a safe place to park cash, thinking a company as big as Tesla is a stable savings account. It isn't. It's a battleground. If you're using investment help tools or a SoFi robo-advisor, they might allocate you to Tesla as part of a growth strategy, but if you're picking this stock individually, you're stepping into the ring with high-frequency trading bots that eat amateur mistakes for breakfast. The drop to $383.76 on Friday wasn't random, it tested a technical support level. If Tesla breaks below $380 in the coming week, the next major area of interest isn't until the 360s. That's a massive air pocket. Conversely, the bulls have a ton of work to do. They need to push the price back above $402 and hold it there to prove that the Friday rejection was a fluke. Until we see a daily close above $405, the bears are technically in control of the immediate momentum. This is a good moment to pause and check the temperature of the room. I want you to scroll down and comment below. How many shares of Tesla stock are you currently holding? And more importantly, did you buy more during the rally last week or were you taking profits? I'm seeing a lot of people saying they bought the top, and I want to know if that's the general sentiment here. Drop a comment and let's compare notes. Now, moving beyond the immediate price action, we have to look at the company itself because the disconnect between the stock price and the business performance is widening. Tesla is no longer just a car company. We know that. It's an AI and robotics company. But the automotive business, the part that actually pays the bills right now, is facing headwinds. China sales are under pressure from domestic competitors who are engaging in a brutal price war. In Europe, sales have been mixed. The only reason the stock is trading at 390 and not 190 is the promise of the future, the Optimus robot, the Cybercab, and the energy division. The energy business, in particular, is growing massively. Deployment is up and margins are healthy. But is that enough to justify a trillion-dollar-plus valuation? That is the multi-billion-dollar question. When you log into your Fidelity brokerage account and look at the research tab, you will see analyst targets all over the place. Some see 500. Others see 200. This divergence tells you that nobody knows how to value the Musk premium. You are not just buying a stock, you're buying a call option on Elon Musk's ability to deliver the impossible. The future outlook for the next 3 to 6 months is going to be dominated by two things: interest rates and the regulatory landscape. If the Federal Reserve signals that they are done cutting rates, or, God forbid, that inflation is heating up again, high valuation stocks like Tesla will get hit the hardest. Online investment platforms will see an exodus as cash moves to safer assets. On the flip side, if the new administration signals concrete steps toward a federal framework for autonomous vehicles, something that supersedes state-by-state rules, that would be the catalyst to send this stock through the $415 resistance and possibly to new highs. We are sitting on a binary outcome. Either the Trump trade euphoria evaporates and we correct back to the 300-350 range to let the fundamentals catch up, or a specific policy announcement provides the rocket fuel for the next leg up. There is also the factor of the individual